on the one hand, you have probably the greatest synchronized slowdown in history, where your second quarter GDP is concerned. But on the other hand, you have this biggest amount of liquidity coming into the market via the various fiscal and monetary policies of the global central banks. So at the end of the day, you have to balance out which is likely to make a bigger impact on stock markets at this point in time. Now, if you're talking about PEs here, I think PE on a short-term basis will become increasingly irrelevant because PE is actually running, and PE, where your price is concerned, is not an independent variable. It's basically reliant on how much of liquidity is actually pushing into the market, which could perhaps actually drive prices even higher. But E reflects the business activity of a company, and certainly business activity at this point is probably pretty much at the bottom, and you're probably not going to see it actually get even worse as countries slowly lift the containment measures. So that's why we have this massive dichotomy actually going on right now, which in other words means that the bifurcation between stock markets and the economy could perhaps actually continue for a little bit more, defying all fundamentals.
So how do you spot value in this market if you're saying that PE as a measure of value is becoming less relevant? Because remember, all that talk about dividend payouts and all of those investors chasing income stocks are really keeping their hopes on payouts coming through earnings. And so if earnings visibility declines, then what do you base value on?
Well, at this point, I mean, you got to bear in mind that this is pretty unusual and abnormal market circumstances because it's an economic slowdown that's been caused by a spread of a pandemic itself, right? And it's not just your normal risk aversion, so on and so forth, right? So it's largely a focus on liquidity and how much liquidity there is in the system. Do bear in mind that for all the $2.5 trillion to $2.8 trillion that the Federal Reserve has pledged to actually bring into the markets, not much of it has actually been reflected in the markets yet. So if you look at the investment grade new issuance as of yesterday, the new issuance has actually totaled about $230 billion for April month to date, and the all-time high was in March of about $261 billion. And and the Federal Reserve has not even bought a single bond in the investment grade market. So in other words, the Federal Reserve has actually solved the liquidity crisis before even having bought a single bond. So again, that shows you how much the market is actually moving as a result of expectations of the liquidity coming through. And as the liquidity gets fed into the market, you probably want to think that your bond prices are likely to actually start recovering even further from here.